Welcome to Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
You did 2 podcasts without me.
Well, we muddled through.
We made it through it.
Well, this one's very interesting. We were preparing for a different topic, and it kind of took a different track. But today we're going to focus on hiring a financial advisor and what you look for. And the conversation got a little dark yesterday when we were talking about this, and it reminded me that in our industry, it's a very low barrier to entry. You just take one test and you can call yourself a financial advisor. And some people don't even take the test and manage to steal people's money. But, to do it legitimately, you just take a test and you can be a financial advisor. So there's a lot of us. There's a lot of us out there. And how do you figure out the good ones from the bad ones? The people that are just looking to live a certain lifestyle and sell expensive products, and the people that are generally trying to guide you to financial freedom, like we do here at Wiser Wealth. But then, this is where the conversation went dark. We got into Ponzi schemes. And it reminded me of a gentleman I met many years ago named Pat Huddleston. He's SEC enforcer. I still think he represents the SEC, but I've not talked to him in probably 10 plus years. But I remember his book, The Vigilant Investor. So I went and grabbed the copy because I remember this story. And I want to lead with this crazy story. So in the 1990s, you can go look at this. It's probably on Wikipedia, I would think. But there was a story of the Geritol gang, basically senior citizens that got their money stolen from them. They met a guy. They were German. They had, homes in Naples, Florida. They come here and they meet with an advisor who's, has German ancestry as well. And they invest money with him. He's promising 18% rate of return, that's always a red flag when you promise rates of return, right? But he promises 18% rate of return, and then he says he lost all the money in the subprime crisis, which is very possible. But just having other things surrounding it, even the authorities afterwards were like, "Hey, something's not right here." Well, this advisor, Amburn, Amburn, he was in Germany, and these groups of investors, I think there are 2 men and a couple, they go to his house and said, "Hey, where is our money?" And he's like, well, the money's gone. The investment went to zero. We lost everything. So they had made a box because they figured he would say that. And they put him in this box. They beat him with their canes and their walkers, and they put him in this box, and they drive him hours down the road to one of their homes, stopping once for gas, where he tried to escape from the box in the trunk of the car, and they broke 2 of his ribs, beating him to get him back in there. So then he ends up in this basement of this house, chained to a metal cot. They burn him with cigarettes and tell him, "Hey, give us our money back." Finally, he says, "Okay, I'll wire you money from a Swiss bank account." So he convinces them to send a fax to Credit Suisse. Now, he has no account at Credit Suisse, but he's able to, on all the instructions, call police. And I guess these people didn't really notice it, or their written English was not real good. Police in German policy in German is actually spelled Police. So maybe that was the difference. But anyway, he has no account there. So Credit Suisse would receive a fax that at the bottom said, call police. So, they strip him down to his underwear, put him in a courtyard to give him some fresh air, I guess. He decides to climb the wall and try to escape. So he's running down the street, and they get in their cars, and they're chasing him. And they convinced, as they're yelling out of their cars, they convince bystanders, that he has robbed them. And so bystanders tackle him, and they put him back in the trunk of the car and drive him back to the house. where they were met with 40 German police, and then this whole thing comes to an end. So his captors, who wanted their money back, they end up in jail. And Ambern is put on trial. Don't know, at the time the book was written, it doesn't say he was guilty or not, which is very interesting. It's a famous story, but it gives us some insight into how angry people are when all their money's gone, right? Especially, this guy, it was millions of dollars put into this real estate venture, supposedly. So you shift that to maybe something even more modern time. So this is a press release from the SEC dated July 20th, 2020. So we're just approaching a year. This is a financial advisor in McLean, Virginia, that the SEC alleges he has taken money from his investors by forging documents. So he's able to pull money out of their accounts and millions of dollars out. Also through a 529 plan savings, he's able to redirect funds. He made $1.5 million in unauthorized transfers from accounts of an elderly advisory client. He did this, and he circled around all the safeguards by changing the address. So he had the address of the client changed to probably his address or some address somewhere else that he controlled. So when they got all the confirmations in the mail, they didn't know it because they didn't receive it. He's pled guilty to this, but the point is that this is it doesn't name the firm. It just says that is a office of a large financial institution. This was an advisor there that was working the system. How do you prevent this? I mean, this guy's totaling, I guess, about $2.5 million. $2.5 million is what he was able to put in his pocket at a large institution, and he did this really to pay for his lavish lifestyle, according to the report here. So how do we prevent this from happening?
We see these things happen from time to time, and it's unfortunate for the industry, quite frankly, as well as it's unfortunate for the individuals who are affected. It happens over and over and over and over again, it seems. And I think the reason may be somewhat to the extent as an investor, a prospective investor, it's very difficult to ascertain the ability and the circumstance of the advisor. Trying to figure out, is this a legitimate advisor and legitimate firm and legitimate investment? But there are certain ways to go about it. An investor has to educate themselves on that first before they can even begin to find out about the advisor and the firm and the investment afterwards. And, we can talk a little bit about that today. I thought it would be a good idea. When these things occur, the reason it gives a black eye to the whole industry, because it puts us all under a cloud, but it also brings out the importance of the evaluation and the due diligence that an investor needs to do on their advisor. And that can actually be a good thing at the same time, because it puts a spotlight on those that are good.
There's illegal things, which two different stories, right? But there's also legal ways to screw over a client.
Very true. Absolutely.
Annuity sales is my biggest thing. I know you roll your eyes, but it's true. It's true. Anytime that you're collecting a 10% commission on selling this product and you get nothing on another product, if annuities were so good, why aren't we all just using Vanguard indexed annuity products?
Well, it goes back to guarantees. They're playing on the fears, but just like that individual guaranteed 18% returns, a lot of times annuities guarantee rates that aren't actually true. But, usually if it's double-digit guarantees, it's kind of a red flag that's probably not true.
Yeah, no doubt about that, especially in today's environment, top of the market, low yield environment. But on the annuity soapbox, it's almost reversed. It's guaranteed you won't lose. Because I've never met an annuity person that said, you're guaranteed to make. They just said you're guaranteed not to lose.
Right.
And people go, oh, great, I don't like losing. Nobody likes losing. But they also, what they ought to tell you is that we guarantee you'll never gain anything either. And annuities do make money, but nothing compared to traditional investing.
Well, they guaranteed not to lose. This is something we discussed in an earlier podcast last year, where we talked about investors the joy of a gain relative to the pain of a loss, and that the pain of a loss is twice as great as the joy of a gain. So when you talk about annuity salespeople preying on that fear, they know what they're doing because it's very real, and they know it, and they know exactly which buttons to push.
Absolutely. And it's all legal. That's my point.
Yes. Mm-hmm.
Nothing illegal about it. Now, you could sell it to someone who it wasn't suitable for. You could also transfer an annuity to an annuity where the advisor gets to double dip, sort of, or just sell another annuity because they already got sold one. And you can't do things like that, not without good documentation that you weren't taking advantage of the person. But there are, man, if you want to go look, there are tons of client complaints. You know, I look at it this way. You fly on an airline and you have a terrible experience and you complained about your friends. You might even put it on social media today and complain about it. But do you ever go to the FAA and file a formal complaint? Well, no. One is we don't know how to do it. It's not easy. And then the process of so long.
It'd have to be a terrible experience to take the time to do that.
I mean, like, you'd have to be horrible. Like,
yeah, because ultimately you still get to your destination.
Right.
Made it safely.
Sort of.
Whereas with an annuity, like you say, they last forever. So that you may never arrive at your
that's the
destination.
same process of filing a complaint against an advisor. Is my point.
Yeah.
Is that people are so upset. They don't just leave the firm. They leave the firm and they file complaints against the advisor. And it's annuity after an annuity in the complaint where the people weren't told. They weren't told what the fees were. They weren't told that their money was locked up for 14 years, right? They didn't know their beneficiary had to pay income tax on the money when they passed away. You know, they're just complaint after complaint. But you sign so many documents when you buy an annuity that very rarely do I see retribution, you know.
Right.
In the end.
Which kind of brings us to this point of how does an investor do due diligence on their advisor and their firm? And that's one of the questions that ultimately comes out and should come out in a due diligence effort, is that how are they compensated, right? So there's a couple different sources that an investor can go to look at, you know, a sampling of questions. The Department of Labor actually lists 10 questions on their website. Now, these are designed for a trustee to evaluate a pension investment consultant. But I took a look at those and then kind of reworded them and said, okay, those same 10 questions, those same 10 topics are relevant when you're talking to your individual financial advisor who may manage money for you. And another source was on NAPFA, which is the National Association of Professional Financial Advisors. They list 10 important questions to ask a financial advisor. And you'd be surprised how many of these 10 questions are almost exactly the same, only the semantics may change a little bit. And what they're trying to do is trying to help an investor, a prospective client, to evaluate the structure of the firm, the revenues received and earned by the firm, and the competency of the advisor and itself. So you take these three topics and creates like what I would call a three-legged stool, you know, that creates a level platform of which you can place trust upon. On the structure of a firm, the questions are things like, do you have any relationships with other firms that you would utilize when making recommendations to me as a prospective client that you may earn revenues from? Okay. Are you independent? Do you custody assets for me, or are my assets going to be held at another firm? These are all types of due diligence questions. On the second topic of their revenues, the stream of revenues, how are you being compensated? How am I paying you, either in directly payments, which is a fee-only arrangement, or are you also being compensated through some of the products that you may offer to me as a recommendation, which is what we consider a fee-based arrangement? And then what is the competency of the advisor? What is their experience? How long have they been doing this? How many clients do they have? Do they have any professional designations? What's their educational background? So with these three general topic areas, I think a prospective client could learn a lot about the firm and whether or not that firm is appropriate for them. And then it comes down to, who do you want to work with? Okay, what's the personality style of the individual? So let's take a couple questions here from each one of these sources. One, the DOL website, and the other one, the NAPFA website. On the DOL website, it asks, do you or a related company receive any payments from money managers that you recommend, consider for recommendation, or otherwise offer to clients for your consideration? If so, what is the extent of these payments in relation to your other income/revenue? Well, you could turn that question around and slightly reword it and ask a financial advisor, does your firm receive any payments from any other service provider, such as a money manager, insurance provider, a law firm that you may recommend, a tax preparation firm that you recommend or that I may utilize to implement my financial plan? And if so, what type of payments do you receive?
Yeah.
Our
answer is none. We don't receive any income from anybody other than the client.
That's because we're completely independent in our structure.
Fee only, and that goes back to, you mentioned commission-based compensation and fee-based compensation are the other two types of compensation out there, and they oftentimes can receive referral fees or other types of commission like that. So that's differentiator there. It's fee only.
Yes, and since you're getting if that's the case, that the advisor is receiving a stream of income that's generated from that referral, that recommendation, does that cloud their judgment when making that recommendation or that referral? On a referral basis, maybe there's somebody else out there that is better suited to me, but was completely excluded from your consideration because they're not paying you a fee or a revenue stream on that. So it's something for the individual to consider when they're talking to a prospective financial advisor. And if that's the case, do any referral fees or commissions or other streams of revenue offset the payment that I would otherwise pay to you directly? And if so, how do you track that? And that's another question right on the DOL website. Or do payments that you receive from being a client, are those offset, in any other way that I would otherwise directly pay to you? So, that kind of levels the playing field in terms of the overall costs. It talks about the structure of the firm. It talks about, how much, revenue that you pay directly or indirectly. And then obviously, you want to find out if the advisor is going to be a fiduciary. So on the DOL website, it says, if you are hired, will you acknowledge in writing that you have fiduciary obligation as an investment advisor to the plan? Remember, we're talking about pension plans in this question, while providing consulting services that we are seeking. So you would kind of turn that around a little bit and say, if I hire you as my financial advisor, will you acknowledge in writing that you have a fiduciary obligation to act in my best interest while providing me with financial planning and investment management services? That seems
really simple.
reasonable. That seems reasonable. Are you a fiduciary to me?
Which not all are fiduciaries. Being an RA, CFPs, and members of NAPFA, you sign a fiduciary oath. So we are fiduciaries, but the other difference would be suitability. So a lot of brokers and other agents, all they have to prove at the time of sale of insurance, annuity, or even some type of mutual fund is at the time of sale that it was somewhat suitable for the client. And then after that, they really don't have to talk to them again until they try to resell or just establish a relationship with them. On the other side, like we mentioned, a fiduciary, you're always doing what's in the best interest of the client and looking out for that client throughout the relationship. So that's the real differentiator there is kind of the suitability standard versus fiduciaries.
You made an important point there, and I'm sure you touched on this in the podcast about the CFP certification. Just because you're a CFP doesn't make you a real fiduciary, though. You sign a fiduciary oath, but if you're working at a big box firm, that is not a fiduciary relationship. Just because the person at, I'll name it, Edward Jones, Wells Fargo, Merrill Lynch, just because you're a CFP there doesn't mean that you're also a fiduciary. You signed a fiduciary oath that you'd work in the best interest of the client while doing planning, but it doesn't mean that you're selling that product as a fiduciary. You're selling the product under the suitability rules. So that's the important distinguishing. That's why I get frustrated with the CFP board, because in my opinion, the CFP board never should have allowed anyone at Edward Jones, Merrill Lynch, Wells Fargo to ever hold a CFP designation because they were not working under the fiduciary framework. However, if you take that approach, you wouldn't see the CFP advertised on TV. People wouldn't really know what the CFP designation was because there wouldn't be enough people to pay money to advertise it. So they do it in order to generate more revenue because it's a business too. But that's the frustrating part is in interviews, people will say, oh, well, I'm working with I think he's a fiduciary, he's a CFP, but he's working at a brokerage house. And you're like, well, no, that's not a real fiduciary.
That's a very important point in that because these firms are not, fiduciary, management firms. So they, therefore, as an employee, that CFP cannot say that they are acting as a fiduciary. They have simply earned the fiduciary, or the CFP designation at that point in time.
Yes.
Right. And so that's an educational aspect. And that's why I go back to the concept of the three-legged stool. All three must be in place. The competency of the advisor, okay, and the structure of the firm must be equal.
Yeah.
Okay. So at a firm like ours, which is an independent, we're a registered investment advisor. Okay. We do act as a fiduciary because we're not affiliated with a broker-dealer. We're not affiliated with any other firm other than ourselves. So it allows us to act as a fiduciary under that role.
Another thing you brought up earlier is part of the three-legged stool is the structure, correct? So if you think about, you asked earlier, who holds my money? Okay.
Right.
We started off with some Ponzi schemes here in our examples, or I guess this is just a bad actor on the SEC example, but it's important that you never write a check to the person that you're doing business with, right? You come and do business with Wiser Wealth Management, the check's written to TD Ameritrade. TD Ameritrade is the one who holds the client's money. We're simply managers on the account, right? Or if you're here under an hourly structure, you are writing a check to us for our hourly service, but it's not investment money.
That's correct.
It's
right.
You're
That's
paying by
for
the
financial
hour
plan.
for financial planning, or if your assets under management, that money is not going to Wiser. That money is going to TD Ameritrade. So it's important that you never write a check. That's what Bernie was doing. Bernie was writing. He owned both.
Bernie Madoff.
Bernie Madoff owned the security company and the advisory company.
That's right.
So a check to either one of those was really a check to him, right? So that's the part that people have to really understand. Who am I writing this investment check to?
Right.
And with Bernie, it's not just the elderly that were taking advantage. I mean, this was well-off, wealthy people. So it doesn't have to just be people that kind of taking advantage of it. It can be people that have done very well, and even investment-oriented that have done very well. Sometimes when you get emotions involved in money, which is easy to happen with behaviors, sometimes you can make some bad decisions when you're not doing your homework like you should.
Right.
And having this, type of structure where you have the advisor separate from the custodian of the assets, what that means, the custodian sends statements to the client, okay, saying this is what we're holding on your behalf. These are all the transactions that have occurred in your account over this period. As the advisor, we send statements as well, saying that these are the investments that we're managing, and this is the return that has been produced in your account. As the client or the asset owner, it's their job to match these two statements up to make sure that they are one and the same from two different sources. So you have confirmation that what we're advising on and what the custodian is holding are one and the same. The other thing is that in a lot of these schemes that occur, they always ultimately result in the fact that the advisor somehow had the ability to withdraw money from the account. Okay?
Yeah, right.
Now, whether they slid that piece of paper over to the client and, just said, here, sign here, and they didn't know. But in our arrangement, we're structured, we cannot withdraw money from client account other than to withdraw fees from the client account, which the client has agreed to do. But as far as just withdrawing money from the account, we simply don't have the ability. TD Ameritrade requires written authorization from the account holder each time the money is withdrawn. Okay, and we have that on file. So, that's another thing to look for. Don't ever work with an advisor that asks you to be able to withdraw money at a convenience factor, right?
Yep, that's correct.
So what are some of the things that NAPFA has to offer relative to doing due diligence? Well, again, they have the 10 questions. I think the first 3 are based upon revenues that they earn. Compensation is such an important part of the relationship between an advisor and a client because humans being what we are, we tend to follow the dollars. And it creates a preference or prejudicial viewpoint on recommendations that offer revenue. Here we're fee only. Matthews, have you ever worked at firms that had a commission structure? Because I've always worked at a registered investment advisor where commissions weren't part of the revenue streams.
Yeah, I've actually seen it, all sides of it, to be honest. I've seen the commission side and the fee-based side of things, so I can speak to how each of these firms differentiates themselves and and operates. Kind of the reason that I moved to Wiser Wealth was to be at a fee only, where you are a fiduciary looking out in your client's best interest and not selling any type of products. So everything we've said is accurate there with the way that these firms hold themselves out to be financial advisors and the way that they're compensated, but not all are created equal there.
On NAPFA here, the next three questions are kind of relative to the standard of care that a advisor should be able to provide a client with. So again, you're asking about, are you a fiduciary? Are you putting my interests ahead of your own? And, have you ever had any sanctions against you relative to the SEC, the Securities and Exchange Commission, or FINRA? So these are things that, questions that should be asked to an advisor. What is the standard of care that our relationship will be constituted under? And have you ever been sanctioned for operating outside of that standard of care?
You can go to brokercheck.com or Google the phrase broker check, SEC broker check, and you can actually see complaint history. Someone once told me it's not if, it's when.
I've heard that same thing.
And I guess there's always chances that you have someone who just doesn't understand and they take you all the way through the process. I mean, I'm not going to say that wouldn't be possible ever, but what you're looking on there is just for gross negligence on the advisor's part. Selling products that the clients didn't understand, and then they get stuck.
It goes back to suitability, like we mentioned. Is it suitable? It's
funny because a lot of times when we're competing with other firms for clients, they'll tell me who they're working with, and I'll go online and I'll look and see, okay, are they another firm like us? And if that's the case, it's probably coming down just to personality and where they feel most comfortable and trust. If it's a big box, then no, don't ever want to lose business to a big box, because that means that, to me, the fact that they're even in the running means the client doesn't fully understand the ramifications of working with that group. And so I like to go into a broker check. And it's funny that certain companies, I'd say almost all their advisors have complaints, certain ones. And I find that very interesting. And it's a cultural thing. It's the sale is more important than the client. That's what it comes down to. And you can see it in the products that they're pushing, because the products that they're pushing, they get in trouble for, are the high commission, high kickback product to the company, but also to the advisor, right? I unfortunately had to start this business in this industry and a firm down in Atlanta, very large multinational firm. And my boss used to tell me, there are 3 people in this relationship, Casey, and 2 out of 3 better be making money. Yeah. And after that lecture, 6 months of that lecture, I finally realized that this is not going to work out for me long term.
You learned what not to do there.
Yes,
I did everything but that. I should be all right.
Yeah, they all got in a lot of trouble many years after I left, when the government started cleaning up house a little better. It's important that you take a look, because a lot of times what you see on the front end is not what's really happening on the back end. It's like anything technology that I ever bought for this firm. The salespeople are really good at telling me how great this product's going to be and how much more efficient we're going to be with it. And then once you get it, it's like it's half of what it does half of what we were told it was going to do.
And then you can't reach out to them. Customer service
right.
too.
And customer service either non-existent or I don't understand the language.
Which is a great segue to kind of the last 4 questions, that NAPFA suggests that a prospective client ask. And that has to do with service delivery and service is offered. So it would behoove us to as a prospective client in this case, to ask, what sort of services can I expect from you? Are they financial planning services or investment management, or a combination of the two? And describe a typical client, Am I in your ballpark, if I can say that, of clients, or am I atypical and that you don't have a lot of experience with? So you want to find out what the experience is of the advisor, and how exactly will you as an advisor help me reach my goals, including how will you help me understand, quantify my goals? I think that's an interesting question. I'm going to leave the last one here for a minute. So would you like to comment on how we help clients reach goals?
I just want to go back to your point there of the services provided. A lot of firms, actually most firms now, say that they provide some type of financial planning comprehensive services, kind of the buzzword in the industry now, just to show that they aren't strictly selling product. But that's not necessarily the case that they are providing comprehensive financial planning. It could be that they put together a short 20-minute plan like you could see online, just for the fact of selling insurance or annuity or some type of product. So really have to differentiate, is the actual planning in depth and really looking after your goals and what you're trying to accomplish, and not just trying to be the ends to mean to end up selling you something.
And how long that plan is projected out to last, I think is important. We have a lifetime ahead of us, and our plans should match that lifetime. Even if it's a projection, it gives us an idea of what we're planning for.
A question that doesn't show up on any of these suggestions is, and maybe it's too detailed, but will you do financial planning, but also how often will you update the plan? Because I feel like a lot of firms are doing, quote, financial planning, but they do it one time. And financial planning was never designed to do it one time. You should be doing it every 6 months to a year. In our case, we make it mandatory that we're going to open up this plan and revisit it once a year, right? But outside of that, it's important that you're reviewing the plan every year, not just one and done. And then another thing too is what services are you going to provide me? So many times people go, well, my job as an advisor is to make sure the plan works, and I'm not worried about anything else. And we had clients in here yesterday that were talking about the trouble of rehabbing a condo. Well, I'm going through my list of people going, okay, who do I know that can rehab a condo and do it on a high end scale that I might be able to connect with them? Who do I know that can help them get a pool in a timely fashion? I mean, heck, I grew up here. I should know a lot of people in a lot of different areas of the community that I could pull together to help that person. So you have to figure out, what is it you want from the relationship? And we're full service. If you need us to contact a laundry service to come and do your laundry every week, by gosh, I've got 3 people here that are set and ready to go research this and help you with it. We're going to do whatever it takes to bring financial peace to a person, but also help them live their best life. And it's easy for us. We have a Rolodex of this stuff, right? Where I feel like other firms are not going to have that personal touch, but some clients may not be looking for that. They may be looking for cheap and easy, or, cheap and walk in and get the bare basics and move on, and not actually have a relationship. I find that the relationship allows us to give better advice, because when the client calls in and says, hey, I'm going to buy a Ferrari, I can go, I love Ferraris too. I like driving by and looking at them. I never would go in, but they're fun to look at for sure, and hear them start up and all that. But hey, our goal was really to fund this account by this amount by this time, so you can retire 10 years sooner. So are you going to be able to do the Ferrari and keep the funding goals? Oh, well, no, I know I'm going to, you're right. That's what I wanted to hear. And I feel like a jerk for saying that, because I just took away the candy, right? But at the same time, that's what they hired me for, was to make sure, or hired us for, is to make sure that the hand is not always in the candy jar, that it's also in the savings bucket, right? So that's something that you have to figure out when you interview. Are you going to do these things for me, but are you actually going to help me live a better quality life now and in the future? Or are you just here to sell me a product and then I'm never going to hear from you again?
Yeah, I mean, Vanguard did a study on that, and that the biggest value that advisors can provide is the aspect of that unknown, just client service outside of just commoditized investment management planning, is really just providing that service, being there for them, and knowing your client.
The money aspect is simply the means to living a better life. And we help them with the money in order to achieve the better life. But as the relationship grows and over time, we understand what that life is, because we're participating with them from a decision standpoint. And the money we help to achieve those goals through the money management and through the financial planning advice. And that's where it all comes together. And that's when our clients, and in the highest level, where any client with any advisor should interact with one another on an aspirational basis, more so than just a financial basis.
So we're breaking all our rules. I never wanted our podcast to be an advertisement of why you should work with Wiser. And people listen to this podcast all over the United States. So the important thing is to take these questions
Right.
here
To do your due diligence.
and to help you do due diligence with your current advisor, but also if you're thinking about changing, even if you're far, far away, we can work with anybody anywhere. But if you wanted to work with somebody local next to you, these are some questions that you can take in and ask.
Right, and to remind the listener where the questions are, on the Department of Labor website under questions to ask a pension consultant, and on the NAPFA website, questions to ask your financial advisor. Great talk, guys. If you liked what you heard today, please subscribe to us on your favorite listening platform.
And let's give them a cheat sheet on the show notes on the website. You go to wiserinvestor.com. You'll see this posting for the Wiser Roundtable. In our show notes, we'll list out these questions for you and our versions of them that you can use.
Great idea.
Have a great day.